I'm Charles Guinn, and I'm a certified aging in place specialist. Today I'm going to share with you the secret of variable interest rates when used with a home equity conversion mortgage, commonly called a reverse mortgage. There's a general misunderstanding among the population I serve about variable interest rates. Most people just don't know the secret that isn't publicized by lenders. Let's start by considering why a bank would make a variable interest rate loan or a fixed interest rate loan. Loans are no longer kept by banks and held as income-producing instruments. Both fixed interest rate loans and variable interest rate loans are packaged and sold as investments similar to bonds. Therefore, the banks that originate the loans are really not interested if the loan is fixed or variable. They both have a market, and the originating bank can make money by selling either. They're going to offer only loans at interest rates where they can make a profit originating and selling the loan. So the only one who is affected by the interest rate is the borrower. I've noticed over the years that borrowers have an aversion to variable interest rate loans in general, and that's understandable. With the subprime loans of the recent past and the extremely high interest rates of the more distant past, some of the folks who had traditional mortgages saw their monthly payments jump higher than they can afford. There were people who were forced to sell, and some who lost their homes. Most people, 62 or over, lived through this time and may know people who got hurt. Those loans were the ones with monthly payments. If those homeowners had the same loans but without the requirement of the monthly payment, they would never have lost their homes. Now I know this sounds silly, but it's true. When rates went up, the only reason anyone was forced to sell or lost their home was because they couldn't make the monthly loan payment. Now the folks who are 62 and older may be considering a reverse mortgage. But a reverse mortgage is not like a traditional mortgage. A reverse mortgage has no required monthly payments. That means no matter what the interest rate of the loan is, you'll never lose your home for not making a loan payment. And the loan is guaranteed for your lifetime. So for those folks, it means that as long as they pay the taxes, insurance, homeowner dues if any, and as long as the home is kept livable, they'll have a home to live in for the rest of their life. If this is true, and it is, why should you be concerned about the interest rate of a reverse mortgage? Well, actually, there are some people who aren't concerned, but most are. For the ones who are, they should know the secret of variable interest rates. For reverse mortgages, there are basically two types of loans, a closed-end loan and an open-end loan. The closed-end loans are loans where you get all the money up front, and during the life of the loan, you can't get any more money out. The closed-end reverse mortgages have a fixed interest rate, and it's usually slightly higher than a conventional loan. They're similar to traditional mortgages, but with no monthly payments due. With an open-end loan, you can take money out during the life of the loan. They're more like a line of credit you would get from a bank, except there are no required payments. For example, you may get monthly income for life, or you may take out some money now and have the rest in a line of credit, waiting, so you could take out more whenever you needed it. These open-end loans have a variable interest rate. This type of reverse mortgage is the most versatile and useful for financial planning purposes like building cash for later in retirement, or increasing dividends from your retirement account, or increasing Social Security benefits. For more information on these uses, see my other videos on those subjects or visit my website at charlesguinn.com for complete details. Because this opened-end type of reverse mortgage is the most useful and it has a variable interest rate, you should know the secret of the variable interest rate. So here's a secret that even lenders seldom explain to their borrowers. Variable interest rates have a fixed portion. Yes, I said that, a fixed portion. Part of the variable interest rate is fixed and doesn't change for the life of the loan. That fixed part is called the margin. The whole rate does not vary, and in today's financial market, only a small portion of the rate varies. So here's how variable interest rates actually work. This may seem complicated, but taken in small parts, it's easy to understand. The variable rate is composed of two parts, the index and the margin. The index is an internationally published rate, and it varies according to the financial markets. The margin is the fixed amount that never changes during the entire time you have the loan, and it's added to the index amount. These two together make the loan interest rate. For example, the index used for reverse mortgages is the LIBOR rate. That stands for London Interbank Offered Rates, which is the rate some banks in London charge each other to borrow money to balance their books each night. There are composites of this rate calculated as the 1-month rate, the 3-month rate, the 6-month rate, and the annual rate. These are among the most common benchmark interest rate indexes used to make adjustments to adjustable rate mortgages. Reverse mortgages generally use either the 1-month rate or the annual index rate. At the time of this video, the 1-month LIBOR rate is about 1/20th of 1%. If you were to get a loan with a margin of 2.50, that would be added to the index of 0.20 to give you an interest rate of 2.70 for your reverse mortgage. That's a pretty good rate. But of course it's not the annual percentage rate, since the APR is based on all the costs plus the length of time that someone has the loan, and the APR would be slightly larger. But now let's consider what would happen if interest rates would double. That 1/20th of a percent, or 0.20, would go to 2/20ths of a percent, or 0.40. So if you add that to the fixed portion of your 2.50, the margin, you get an interest rate of 2.90. Interest rates doubled, but the loan interest only went up 1/20th of a percent. Well, what if they quadrupled? That would mean the index would be 0.80, and when you add that to the fixed portion of the interest rate, it makes the loan rate 3.30. This shows how the variable interest rate does not double if the interest rate doubles, or does not quadruple if the interest rate goes up 4 times. This is the secret that most people don't know about variable interest rates. They have a fixed portion that stays the same for your entire loan. When you couple that with the fact that you can't lose your home for not making a loan payment when you have a reverse mortgage, this puts the homeowner in a very secure position. My goal is to see that people can have a comfortable, secure place to live for the rest of their lives. And when there is a valid financial use for a reverse mortgage, I know that goal will be accomplished. There's a lot more to know about reverse mortgages before you would get one. One way to learn about them in detail is to visit my website at charlesguinn.com. Also, you may see more of my videos that provide simple, easy to understand answers to questions such as, are reverse mortgages really more expensive? What are the new financial and credit qualifications? And how do reverse mortgages affect income tax, Medicare payments, Medi-Cal, Medicaid, or VA benefits? To get the latest videos, you may want to subscribe to my channel. The home equity conversion mortgage was designed to help people with certain financial needs and goals. Correctly applied, it can help you have a place to live for the rest of your life. But if used the wrong way, it can be devastating. So I would like to leave you with one thought. Don't get financial products like investments, insurance, and mortgage loans on the internet or over the phone from an 800 phone number salesman. Make sure you know the qualified professional you're dealing with, where they're located, how to contact them after the loan closes, and know that they are dedicated to doing what's in your best interest. And that should include telling you not to get a reverse mortgage if it's not the right thing for you. For more information on this topic or anything to do with aging in place, Social Security maximization planning, or reverse mortgages, please visit my website at charlesguinn.com. Thank you.